If you're scratching your head and asking yourself why the stock market is rallying so hard despite the real economy taking the biggest hit after the Great Depression, let me explain. Hi guys, this is Dan from the Investment ABC, and in this video I'm giving you reasons to be bullish and reasons to be bearish on the stock market and let you decide which side you want to pick. At the end of the video I'm giving you also my personal opinion on where the markets are heading. This market probably is the most polarizing I have seen so far in my 20 years in the markets. The stock market declined 38.5% from its peak in February 2020 to its low just 1 month later. We all know supposedly the reasons for the decline. It's the mask we have to wear now when we exit our homes. Since hitting the lows in March 2020, the stock market rallied sharply back and is currently still rising. At the moment, we are 32% higher from the lows of last month. Many stocks are 70% to 100% up since then. So what is going on? We have two theses here. The first one is the bullish thesis, which is saying that this was the shortest bear market in history and that the bear market is dead. Bulls are proclaiming the rebirth of the bull market. Technically, they're right, since the bull market starts when stocks rally more than 20% of its lows, which is the case now. So here are the arguments for the bullish case in my opinion. Number one, this current crisis was caused due to a health crisis and not due to the weakness in the underlying economy. Unemployment was at historic lows and earnings were good, so many bulls think that once this current crisis is over, the economy will reopen and pick up again and do fine. Many of the jobs lost will be regained again and the recovery in the real economy will be V-shaped and strong. The stock market is always pricing in events and everything bad is already priced into the current valuations. This includes disastrous earnings. The stock market is anticipating bad earnings and it expects that sometime in the future earnings will recover strongly. The crash we have seen was the fastest decline into a bear market in history. So the bulls argue that this crash was so fast and violent that the weak hands got flushed out way quicker than it would be normally the case. So if there are no weak hands left, the stock market can only go up from here until the weak hands enter at a way higher price. Number 3. The retail investor morphed from a sheep into a wolf. With the help of the alternative media, information is accessible to everyone. So learning how to make money in the stock markets is easier than ever. When we had this crazy crash, many retail investors, instead of panic selling, bought the dip and hold their stocks for the long run. This helped the market to stabilize and bounce. Number 4. If you just listen at the news and the alternative media, you will figure out that the sentiment is still very bearish despite the recent run-up in stocks. Investors aren't trusting this rally and the majority is expecting to see at least another retest of the lows. So the stock market is climbing the wall of worry and leaving those who are waiting for another crash to re-enter behind. At some point, those investors will lose their patience and slowly enter the market, which will add fuel to a further increase. The market most of the time is punishing the majority of the people and rewarding those who are swimming against the herd. The Federal Reserve just printed an unprecedented amount of currency to counter the fall in stocks and to support the economy. It printed $2 trillion in the span of just 2 months. It took the Fed 12 years to increase its balance sheet from $1 trillion in 2008 to over $4 trillion by February 2020. During this time, the stock market rose from roughly Dow 7,000 points to Dow 30,000 points. God knows how far this 2 trillion injection can boost the market despite deteriorating fundamentals. Dow 40,000, 50,000. It seems like the sky is the limit, especially if you add the fiscal policies of the governments around the globe to support their citizens with free money and stimulus programs. Many institutions, trading boards and retail investors just jump back into the market no matter what the fundamentals look like when they know the Fed won't let the market fall. It is practically front-running the Fed and jumping in before everyone else does. In my opinion, many investors are betting that the Fed will at some point just buy directly ETFs and stocks, so they are positioning themselves accordingly. The final reason, and maybe the strongest in my opinion, is that yields for government bonds are at a record low and investors don't get any interest parking the money in cash. There is no real alternative than to buy solid dividend paying companies. Many investors were just praying that the stock market would pull back to get in and earn some returns on their investments instead of letting inflation erode the value of the currency. Investors know that those trillions injected into the economy will lead to higher inflation rates in the future, and they don't want to be in cash when that happens. Furthermore, more and more people don't trust the governments and banks. They feel it is safer to have money in stocks, which is some form of tangible asset, compared to just parking it in banks, which are at the verge of collapse anyways. If you look at the chart of some major banks, it is no surprise that more and more people are mistrusting the bank. In 2008, the 10-year Treasury yield was at 3.8% when the financial crisis began. The yield collapsed to 2.3% when the stock markets bottomed in early 2009. Currently, we have a much lower 10-year Treasury yield at around 0.66%. When the bond market stabilizes, money will flow out of bonds into stocks, which will support prices. You can see that there are enough valid arguments to be bullish on the stock market despite the current issues we are facing right now. So, we heard the bulls, now let's see what the bears are saying. Number one, this current stock market crash was not due to a health crisis like many bulls are saying. The health crisis was just the catalyst for it. The real reason lies deeper, and that is that the market was just too exhausted since it was rising for more than a decade now. This increase in stock prices was largely fueled by increasing debt levels across the board. Corporations and also households took advantage of the ultra-low interest rates environment and either bought back their own shares or spent it on $1,000 iPhones they can't really afford. At some point, the ability of these individuals to take on more debt despite low interest rates led already to a divergence between the real economy and the stock markets before the outbreak. Now corporations need to accumulate even more debt to survive this health crisis. Many of these corporations won't be able to buy back their own shares anymore in the next few months, which will lead to the loss of one of the major drivers for the increase in stock prices. We can see that in 2019, the S&P 500 stock buybacks were around 750 billion US dollars. Most of these companies did not save a lot of cash for a rainy day since it was quite easy to service the debt with the generated earnings. Unfortunately, revenues and earnings will take a big hit now while corporations need to take on even more debt to survive. The bears are expecting a lot of companies to break down under the debt load, which will lead to further turmoil in the stock markets and will make it harder to reduce quickly the unemployment rate. The amount of unemployed people in the US increased to 33 million so far. This is a staggering 20% unemployment rate just in the US alone. We can expect many other countries to have similar employment numbers. Many of these people who lost their jobs won't come back to the workforce once the dust settles. Either there won't be enough jobs left due to bankruptcies, or they just figure out that being unemployed has a lot of benefits compared to working. Since most of our GDP growth is due to consumption and the spending of one person is the income of someone else's, the economy won't recover in a V-shaped form. It will be a long depression, especially since the amount of debt in the system to counter the breakdown has been increased significantly. Furthermore, there is the risk that many people will change their spending behaviors, in my opinion. People might want to eat more homemade food since it is cheaper and healthier, or they will think twice to spend on luxury items, or they will just start to save more money for a rainy day. No one knows for sure how consumer behavior will be affected. The second argument is the market is forward-looking, and with the crash it already anticipated disastrous earnings and high unemployment numbers for the next 2 to 3 months. But with its sharp recovery now, it is also expecting a quick decline in unemployment numbers and a quick recovery to normality once the economies are open again. The bears are expecting that once the economy is reopened, earnings won't recover quickly but will keep declining. There is a great chance that we will actually see a second bigger outbreak in fall or winter once the economies are fully opened again, similarly to the Spanish flu. If governments around the globe lock down their economies a second time, it will undermine confidence totally, and lead to another bigger crash than the one we experienced in February. The third argument: in the short term, fundamentals don't matter, but long term, stocks are moving in correlation to the underlying earnings. Currently, the stock market is as expensive as prior to the crash when you consider the PE multiple of the S&P 500. Bears are expecting that analysts are still too optimistic in forecasting earnings, so that the PE multiple will most likely increase significantly in the coming month. Other valuation metrics like the Buffett indicator are still very high when you consider that GDP is forecasted to fall by more than 30% from April to June. Furthermore, 10-year Treasury yields collapsed from 1.6% in February to currently 0.64%. Big money is going into bonds to avoid losses in the stock market, which drives bond yields lower. Normally, we would expect bond yields to rise again once investors believe that the stock market would give them a better return. What is interesting is that the 10-year Treasury yield did not rise much despite this monster rebound in the US equities. Bears believe that big money is not believing in that rebound and therefore stay in bonds. Another indicator flashing warning signs is the oil market. We were witnessing historical events in the oil market. The futures contracts for WTI for the month of May went below $0, and it looks like the June contracts will most likely do the same. There is virtually no storage for oil left, and the demand collapsed. Many oil companies were already on the verge of bankruptcy due to high debt levels, and it looks like many of these companies will go bankrupt soon. The government will most likely bail out the major ones, but many smaller ones will vanish. This will also lead to higher unemployment numbers and reduced economic activities in some US states. In every bear market, there are violent rallies to the upside. If we have a look at some prior bear markets, we can clearly see that they tend to have multiple rallies before the bear market finally ends. Bear markets end in despair, and only a handful of bulls survive it normally. This chart here shows us the psychology of the markets. It looks like we are currently in the complacency phase where investors think that we will get back to business as usual very soon. Shortly after this phase, the stock market starts to roll over again and investors will wonder what is going on. Since this bull market was fueled mostly by huge amount of debts, where bears believe that this is just the beginning and that this bear market in stocks could last longer than 2 years. Some bears are observing that investors are more and more buying the big tech stocks, which are likely less impacted by the outbreak and have a strong balance sheet. This leads to tech stocks like Amazon or Facebook to rise and compensate for the decline in other stocks in the real economy. The 5 biggest US companies are making up 20% of the whole market capitalization of the S&P 500 currently. This is risky for the whole market when one or more of these big tech companies get in trouble, or they just get to a point where investors are not willing to pay such high valuations anymore. We will see how the earnings of these tech companies have been affected when they report earnings. Number 6, if we just look at the monthly chart of the S&P 500, we can see that the market is touching its long-term trend line over and over again. The bears are expecting to touch this trend line again during this current bear market, similar to the previous bear markets of 2001 and 2008. The Fed is currently providing unlimited liquidity to the markets, but bears are expecting that the Fed will still be behind the curve with creating new currency and that the deflationary forces will get stronger and stronger the more people stop spending. The real fallout could start when the actions governments around the globe took to protect loan defaults end. Many property investors, for example, don't need to pay their mortgages for the next 6 months, which will protect them from defaulting. But what happens when the 6 months are over and the problems aren't resolved by then? I hope you enjoyed the arguments from both sides, bulls and bears, and could make up your own mind which camp you support. I for myself bought stocks when the Dow was sub 19,000, and I said in my video back then that the panic was at its extreme and that a good bounce would be imminent. Now I am bearish and expect the markets to retest the lows in the next 3 to 6 months at the latest. I'm expecting that the recovery will take much longer than most analysts think, and that the markets will at some point realize exactly that. Remember how the markets seemed to be resilient to what was happening in China during the outbreak? From one day to the other, investors realized what the outbreak really meant for the global economy. I think a similar second crash will occur at some point soon. This is just my opinion and no financial advice. I could be completely wrong, therefore, I'm prepared for all outcomes. I still hold my core positions in case the market is rallying further, but at the same time have also increased my cash positions by selling all my trading positions at the moment. That's it, guys. If you liked the video, please support the channel by pressing the like button, share and subscribe for more videos like that. Also comment if you are bullish or bearish right now. Bye and see you in the next one.